Picture this. London, July 1946. You are a successful physician who has just survived the Second World War. You have worked tirelessly, lived prudently, and accumulated £10,000 in government bonds and state bank deposits. You believe you have achieved financial security. You trust the institutions that hold your wealth. Just a few miles away in the financial district, an industrialist is looking at the same post-war economy and doing the exact opposite. He is quietly liquidating every pound sterling he holds. He is aggressively acquiring agricultural land in the shires, taking on massive, fixed-rate debt to purchase heavy manufacturing equipment and moving whatever capital he can into Swiss bank accounts. Over the next 3 decades, the British government, buried under an impossible mountain of war debt, does what every heavily indebted sovereign nation does. It quietly inflates the currency away. By the mid-1970s, the purchasing power of your £10,000 has been systematically annihilated. You are forced to rely on a diminishing state pension just to heat your home. The industrialist, who recognized that holding cash during a sovereign debt crisis was a mathematical trap, holds physical assets that have multiplied exponentially in nominal value. His wealth crossed the generational divide intact. Your wealth evaporated. This was not an accident of the markets. This was a mechanical, deliberate wealth transfer. It happens in every century, in every major empire, under the exact same mathematical conditions. And it is happening right now. Today, millions of financially responsible, highly educated people are making a fatal miscalculation. They look at their bank accounts, see a high-yield interest rate, and feel secure. They believe they are outsmarting the market by holding cash and earning 5% risk-free. But if you carefully examine the balance sheets of the global financial elite, the legacy family offices, the sovereign wealth funds, and the central banks themselves, you will see a completely different reality. They are not hoarding cash. They are executing a coordinated, historically proven blueprint for escaping a collapsing monetary regime. They are preparing for a systemic transition. By the end of this analysis, you will understand the exact mechanical framework the wealthy use to protect and multiply capital, while the middle class saves itself into poverty. To understand what the financial elite are doing, you must first understand the invisible architecture of the trap that has been set for the cash saver. The fundamental illusion of modern finance is the confusion between nominal yield and real purchasing power. When a bank pays you 5% interest on your fiat currency, it feels like growth. But interest rates do not exist in a vacuum. They exist relative to the expansion of the money supply and the debasement of the currency's purchasing power. Look at the mathematical reality of the United States. The national debt stands at $38 trillion. The debt to gross domestic product ratio is expanding at an entirely unsustainable velocity, and the interest payments on that national debt are now higher than the entire military budget. This is a mathematical event horizon. A government in this position has crossed a threshold where it can no longer tax its citizens enough to service its obligations without triggering an immediate economic depression. There is only one historical escape valve for a sovereign state trapped in a debt spiral of this magnitude. They must debase the currency to inflate away the real value of the debt. When a government dramatically expands the currency supply, the purchasing power of every unit in circulation collapses. Therefore, if the currency is being debased at a true rate of 10 or 15% annually through monetary expansion, and you are earning 5% in a savings account, you are not generating a yield. You are locking in a guaranteed compounding negative return. You are effectively paying the government's debt through the invisible taxation of inflation. The elite understand that fiat currency is not a store of value. It is a political instrument designed to transfer wealth from the creditor to the debtor. And right now, the biggest debtor on the planet is the state. Holding cash is volunteering to be the counterparty to a sovereign default. Because the elite understand this mechanism, their first defensive maneuver is highly counterintuitive to the average saver. The middle class is taught to fear debt, to pay off their mortgages early, and to live completely debt-free. The financial elite do the exact opposite. They weaponize fiat debt to build permanent wealth. During periods of severe monetary debasement, fixed-rate debt becomes an asymmetric financial instrument. It functions as a direct short position against the dying currency. The most documented historical proof of this strategy occurred during the devastating hyperinflation of the Weimar Republic. While the German middle class held on to their bank deposits and watched their life savings evaporate into worthlessness, a magnate named Hugo Stinnes executed a completely different strategy. He borrowed enormous sums of paper marks and used that debt to purchase hard, productive assets like coal mines, shipping lines, and steel factories. As the currency collapsed, the real value of his factories remained completely stable, but the debt he owed melted away into nothing. He repaid his massive loans with paper money that was practically worthless. He effectively acquired an industrial empire for free. The modern financial elite are executing a sophisticated version of this exact mechanism today. They secure long-term, fixed-rate debt denominated in a currency they know is mathematically destined to lose its value. They use that borrowed capital to acquire assets that possess intrinsic scarcity and productive utility. If inflation dramatically accelerates over the next decade, the nominal revenue generated by those assets will rise to match the inflation, but the cost of servicing the fixed-rate debt remains frozen in time. The inflation itself amortizes the loan. The currency debasement pays off the mortgage. The elite do not fear debt during a sovereign crisis. They embrace it, provided the debt is fixed, long-term and attached to an asset that cannot be printed by a central bank. This brings us to the exact nature of the assets the wealthy are aggressively accumulating. They are not buying paper representations of wealth. They are orchestrating a massive flight into productive scarcity. When a monetary system begins to fracture, the economy does not simply stop functioning. It reorganizes itself around the physical infrastructure of reality. The elite are stripping their capital out of the banking sector and anchoring it to the physical earth. Consider the quiet, systematic acquisition of agricultural land by institutional funds and billionaires. This is not a coincidence. Farmland represents the ultimate unprintable asset. It produces the one fundamental requirement that human civilization cannot negotiate away, which is calories. During the Great Depression, when paper wealth evaporated and urban unemployment devastated the middle class, individuals who owned productive agricultural land possessed a profound survival advantage. They produced their own sustenance, generated stable utility, and isolated themselves from the collapse of the financial markets. The academic data confirms this principle absolutely. During the severe financial crisis of 2008 and 2009, when the stock market collapsed by 46%, the value of farmland actually increased by 17%. Agricultural land possesses incredibly low volatility compared to equities, and during periods of high inflation, its returns historically average double the inflation rate itself. The elite are acquiring millions of acres of farmland, water rights, and energy infrastructure because these assets generate utility regardless of what happens to the underlying currency. If the dollar fails, the land still produces crops. If the global monetary system resets, physical infrastructure still commands value. The currency used to measure the asset may change, but the asset itself remains completely intact. But the elite do not limit themselves to raw land. They also position capital in highly specific types of corporate structures. The conventional wisdom is that a collapsing economy destroys the stock market. The historical record proves this is entirely false, provided you own the correct equities. When a currency fails, the nominal price of real, productive companies actually surges to match the rate of inflation because the underlying factories, equipment, and inventory have not disappeared. However, the elite understand a critical distinction that the retail investor almost always misses. Domestic companies that rely entirely on the local collapsing economy will see their real profitability destroyed, even as their stock price rises in nominal terms. The smart capital flows exclusively into productive equities that possess robust export capabilities and international revenue streams. If a manufacturing company operates in a country experiencing currency collapse, but exports its products to stable foreign markets, it receives its revenue in hard foreign currency. Simultaneously, its domestic labor and operational costs, denominated in the collapsing local currency, decline in real terms. This dynamic drastically improves the real profitability of the company. During the sovereign debt crises in Latin America and Asia, direct investors who held manufacturing facilities capable of redirecting sales to export markets survived and thrived, while domestic-only investments were annihilated. The elite are currently rotating their capital into multinational conglomerates that produce tangible goods, control global supply chains, and generate revenue across multiple disconnected jurisdictions. They are buying companies that are bigger and more resilient than the countries in which they reside. While the private elite secure land and productive infrastructure, we must also examine the behavior of the institutions that control the global monetary system itself. Central banks operate with access to macroeconomic data and geopolitical intelligence that the general public cannot fathom. If you want to know the true health of the fiat currency system, you do not listen to what central bankers say in press conferences. You watch what they buy. Right now, global central banks are purchasing physical gold at the fastest pace recorded since the mid-1990s. For 3 consecutive years, central banks have acquired more than 1,000 tons of gold annually, double the average of the previous decade. They are accumulating more gold than United States Treasury bonds for the first time in modern history. This behavior is a massive, flashing warning signal. Central banks do not buy thousands of tons of heavy, non-yielding metal because they are optimistic about the future of paper money. They buy gold because it is a Tier 1 reserve asset that carries absolutely zero counterparty risk. For the financial elite, gold is not a speculative investment. It is not an asset you hold to generate quarterly dividends or corporate earnings. Its entire mathematical function is to refuse to be debased. When the supply of fiat currency explodes into the trillions, the purchasing power of each paper unit systematically collapses. Because the physical supply of gold cannot be arbitrarily expanded by a printing press or a political committee, it becomes more valuable by default. The elite do not view gold as a mechanism for buying groceries during an emergency. They view it as a bridge. It is a highly condensed, universally recognized unit of stored economic energy designed to carry purchasing power across the chasm of currency failure, preserving wealth until a new monetary system is established on the other side. The institutions that print the currency are trading that currency for physical gold. The private elite are simply mimicking the behavior of the architects of the system, yet even acquiring productive land, strategic equities, and precious metals is not enough to ensure complete protection. The most sophisticated layer of the elite strategy involves jurisdictional architecture. The wealthy understand that the greatest threat to capital during a sovereign debt crisis is not just market volatility, it is the desperate actions of a failing government. When a nation cannot service its debt and its currency begins to fracture, the state inevitably turns hostile toward its own citizens' wealth. Governments institute capital controls, implement wealth taxes, and forcefully restrict the movement of money across borders. If your entire net worth is trapped inside the banking system of a single failing jurisdiction, you are completely at the mercy of the political class. The historical precedent for this is absolute. Look at the modern collapse of Lebanon. For over 2 decades, the Lebanese pound was pegged to the dollar, and the banking system appeared rock solid. Professionals saved their money in domestic bank accounts, believing it was secure. When the state's debt crisis finally broke the peg, the currency lost 98% of its value in 4 years. A lifetime of savings became mathematically worthless, but the individuals who had moved their wealth into foreign hard currencies, held physically outside the domestic banking system, maintained 100% of their purchasing power. This was not market fluctuation. This was the difference between total financial annihilation and absolute survival. The global elite engineer their lives to ensure they are never trapped in a single jurisdiction. They acquire second passports and foreign residencies. They establish offshore trusts in stable legal frameworks. They hold physical assets in countries with low debt-to-GDP ratios and strong property rights. They deliberately separate the jurisdiction where they earn their money from the jurisdiction where they store their wealth and from the jurisdiction where they actually live. By creating a decentralized personal infrastructure, they ensure that no single government decree, no localized banking freeze, and no isolated currency collapse can fundamentally threaten their family's security. They are buying legal escape hatches long before the exits become crowded. We are living through a profound transition. The global financial system, built entirely on fiat currency and expanding sovereign debt, is reaching its mathematical limit. The warning signs are not hidden. The average lifespan of a fiat currency is 27 years. Every purely paper monetary system in human history has eventually reverted to its intrinsic value of zero. The United States dollar, stripped of its gold backing in 1971, is steadily losing its share of global foreign exchange reserves, traveling the exact same trajectory the British pound followed during its decline as the global reserve currency. The transition will not look like a sudden, cinematic apocalypse. It will look exactly like what is happening right now. It will look like a slow, grinding erosion of the middle class. It will look like groceries doubling in price, housing becoming permanently unaffordable for the average worker, and the value of wages stagnating in real terms. The system will not formally default on its debt. It will simply print the difference, transferring the cost of the sovereign crisis onto the backs of anyone holding cash and receiving a fixed salary. The financial elite are acutely aware of this trajectory. While the middle class seeks the illusion of safety in high-yield savings accounts and domestic government bonds, the wealthy are executing a quiet, systematic evacuation. They are shorting the currency with fixed-rate debt. They are anchoring their capital into productive farmland, energy grids, and global logistics networks. They are stockpiling the apex reserve asset of physical gold, and they are moving their wealth across borders to isolate themselves from the desperate overreach of indebted governments. They are doing this because they understand the ultimate historical truth of economics. When the rules of money are rewritten, paper assets that depend on institutional validation evaporate. Tangible assets that require no external authority to prove their worth maintain their value absolutely. The autopsies of fallen economies are written. The mathematical patterns are visible to anyone willing to observe them without emotional bias. The only variable left to determine is how you will react to the data. You do not need to be a billionaire to apply these principles. You simply need the psychological discipline to recognize that the conventional wisdom of saving cash is a mathematical trap designed to drain your economic energy. Shift your mindset. Study the mechanics of monetary history, secure tangible utility, acquire productive scarcity, and remove your reliance on a single point of institutional failure. The architecture of the next financial era is being built right now by those who understand the pattern. The only question is whether you will adapt your strategy in time or whether you will be left holding the paper of a forgotten system. Position yourself accordingly.